Welcome back, everyone. After a month of holidays and delays on our reports from the CFTC, we can finally get back to it as we got our report in time. Have you been following the narratives of gurus telling you the bull market is over and falling into their traps? Panicking out at the bottom, chasing price back up? Or are you stepping back and observing where the narrative is coming from, where the size is that's actually in control of the market, so then you can piggyback off of this? Do you want to finally make the turn in your trading and become profitable? Or do you want to continue to system hop, spend more money on multiple courses or indicators, and in a few months move on to the next course in Guru? We show our trades, we work with our students, and we are traders ourselves, not just narrative pushers. And clearly, we aren't marketers, only like some other rooms. All this last month is a repricing of our ball underwater. Yet during this whole time, we've gotten a lot of people shaken out, a lot of money floating around now on the sidelines and falling through the skies in the markets. And that is coming to an end right when earnings season begins. This week, we will review from a macro standpoint what has been going on and also a little bit about how to use our levels. First, just a quick reminder that derivatives trading is inherently risky and past performance is not indicative of future returns. So we've been going over this, and the red here is our commercial position, and you can see that they were very short as we headed into that repricing of volatility, and they've been short for a while. That's the function of their business. And now into these drops at the start of the year, they have been covering. They're still net short, but have used the last month to cover a very large portion of this. Next week on the report, we'll get the data for what happened this past Monday on the 13th when we bottomed around 5,800 on the ES. And we'll be able to see what their positioning is, but now they've freed up the capital and the space to continue to make the markets. During this time, we want to peek behind the curtain and see what each player is doing and how these commercials are laying the traps in the market. And fund managers had been 100% invested heading into the FOMC meeting on December 18th when our ball popped out from underwater. They have since dropped down to 65% invested. And last week, we bought 5% of their portfolios, chasing the price on this move higher. The last 18 months, every time that we've seen these fund managers get down to 60 to 65%, we can go back to August 5th, we can go back to April, we can go back to October of 2023. That is when we've seen the market bottom. And we see the buy and the dips occurring on the macro perspective. We push the market up from a commercial standpoint, get 100% investment, then shake everybody out again and rinse and repeat. And that's all that's been happening on the fund manager side. Now, in terms of our death funds and algorithmic strategies, they've also cut down their exposure from over 100% buying on margin to 60% invested with plenty of cash on the sidelines. 60% tells us there's about 300 billion sitting on the sidelines here. And that's a lot of money that we can see start becoming supportive in the markets again. We did see our vol up and cash up scenario. That's the outlier usually in this relationship. At the end of last year, we're going to continue watching for that for a true blow off top scenario. And market makers have been oscillating this last month between risk absorbing and risk compression. And you'll notice that probably in your own trading when all of a sudden the trades you were using aren't working. And then you change a little too late into your bias, and now you're getting shaken out on the other side. That's what happens and why we watch our line in the sand, because that tells us what the commercial side of the market, the market makers, are going to do and want to do when they are balancing their books. And if you don't know where the line in the sand is, you can go back to April and August of last year again to see how this has played out and why our students are the most prepared in the markets. We see these shifts coming, we see the changes in capital, and we then decide when to engage. So these were our levels last week for the S&P, for the ES contract, and we had our rotational zone and our upper target. This was posted Monday morning pre-market, and you can see how this played out. When PPI and then CPI came out, that gave us our push outside of our weekly upside rotational level and the break, and we almost got to our target, which we are just now pushing into this morning on MLK Day and ahead of the inauguration on some of Trump's tweets. Now, how we want to look at these, when we put out our levels, those are our roads for the day or for the week, depending on what time frame we're watching. When we look at our positioning in the market, that is the expected time of day. Are we in rush hour? Are there a lot of people on the roads? Or is it middle of the day and the roads are cleared? And then is everybody going in the same direction, or do we have some people driving the wrong way down a one way? When we look at how to trade our levels, we are watching the traffic pattern. And as the boss taught us in 1987, or for you Gen Zers, Olivia Rodrigo, one step forward, two steps, or three steps back. What is the dancing rhythm? And if you look at our NQ here, it's the same thing. We take a big step and then a couple smaller steps, stair step, and then up. So we're doing one big step up and multiple steps back, and continuing and monitoring how that traffic pattern, how that movement in the market is playing out as we come into our levels. So when we have our entire plan and we know who will step in, we wait for our signal. And that is when the light turns green or red, telling us when to start driving on the road or when to stop. So we want to interact at the intersection and not make a turn in the middle of the road and crash. And we can see this here on the S&P. We made our move down, up, bigger move down, smaller move back up. And now we started getting our change in that dancing rhythm. And all at our rotational level, PPI comes out and we get our first move up, still a shorting move overall. And then CPI comes out and you want to be long because you can see this turn happening. And we can also look at the positioning, and we'll dive into that as well, because we give you this on our daily reports. Who's in the market? Is there too much insurance? And what happens if there is too much insurance in the markets? And we don't want to be worried about every tick up and down in the market. It's the same as if you're on a road trip. You don't want to worry about every car changing a lane if it's not going to affect you. You want to pay attention if somebody is not and they are swerving, but you don't want to be panicking over every single car around you, or you're going to be the one getting in a crash. And that's the exact same way that we want to look at the markets. We aren't focused on every single little move, but on the big rotations, big market, and overall structure. And when we have that and we look at the positioning coming into events like CPI, again, we know this the day before. We monitor this and look at this. And if this is the expectation for the most downside move we're going to get, and people are pricing in 50% or 100% beyond that, there's too much insurance in the market. And we've gone over this again and again, and go back to older videos if you don't understand this. But if everybody's positioned one way, now the crowded trade becomes the pain trade. And this is how we capitalize. These are our real trades this week. And we got in with a 3-tick stop on PPI for 30 points or 40 points. And then we got in on CPI with about a 4-point stop for over a 100-point move. And so if you are following a guru that is telling you to get in and get out and get paid in the market, and you look at your stats and you're still losing because your win rate is huge, but your losses are far bigger than your wins, then try to check out some real traders. There are plenty of traders out there that are very successful, very profitable, and understand the markets. And if you want to understand how we're seeing the market, where you can get 30 to 1 trades, 25 to 1 trades, and know who's in the market ahead of time so you know when the data should be traded or not, then check out our upcoming courses. We held our rotational low, and that was the big sign at the start of the week that we were going to go higher. And this was the easiest 200 points of the week in the market once we had CPI come out around 5,900. Once we had the hold of our rotational low at 5,820. These were the easiest 100 to 200 point moves, and they were highly predictable based on where the cash is in the market. So are you falling for the narratives and that the sky is falling and Chicken Little is calling for the end of the world? Or are you following the money and understanding that it's all a marketing mechanism to get money out of the market, get money into the market for liquidity? And so if we look here at this week's levels now, as we come into a new week and the inauguration and just ahead of earnings, we are looking for a rotational price action here between 59.19 and 60.63, which is right where we're getting to, right at our rotational high on MLK Day, right before the 9:30 open. Now the market does close early today, just remember that. But there are trillions on the sidelines, and our line in the sand is the key if that is going to get deployed or not. And we will post our daily videos this week where you can check out where the line in the sand is. But as long as we hold it, then we're looking for, again, new all-time highs. And we'll watch Trump post on either X or Truth Social that the market loves him and showed it with its best performances. And however he wants to spin that and play that, um, as he will. But this is, again, the marketing of the markets. So fund managers are just like you and me. They chase price up and they sell when people are panicking. Again, that's how we were before. We learned how to read the markets, how to see who's in it. And so now we let the fund managers panic and then we start collecting their money that they're leaving behind. That is why the only thing that matters is the money and the flows in the markets. Follow the money and you can greatly enhance your edge. If these videos help you, don't forget to hit like and subscribe. And if you want to level up our trading, then check out our website. Have a great week, everybody, and happy MLK Day.